Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Good morning, good afternoon, and evening, and welcome to the first of two preview shows this week from LiveSquawk. Today's show previews this afternoon's FOMC interest rate decision, as well as a look at tomorrow's US GDP release and Friday's PCE report. We'll also take a look at the Mag 7, well, more in particular, NVIDIA among the big tech firms and the implications of this week's DeepSeek. We'll have a quick look at that as well. I'm joined today by two experts. My name's Harry, don't forget that. And I'm joined today by two experts in their respective fields, Steve Miley, co-founder of Trade Day, and Joseph Choi of the popular market blog, The Curve Advisor. Welcome to you both. I'll bring you both in shortly. Anyone who doesn't know who we are, LiveSquawk.com is a financial audio news service. It's a real-time news aggregator, and we broadcast live over the internet through our platform. So please visit LiveSquawk.com, have a look at what we do and see if it will help your trading day. Before we crack on, I want to go over some legal smatter that you need to be aware of. So the content provided on this channel is for informational and educational purposes only. I'm not a licensed financial advisor, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We at LiveSquawk are not responsible for any losses, or my guests are responsible for any losses or gains that may result from the following the content on this channel. And with that, again, I'd like to introduce Steve. Oh, well, before I do that, actually, before I bring them in, let's have a quick look at why we're here. So predominantly, we're looking at the FOMC interest rate decision that's due out this afternoon, wherever you may be. And I just want to give you a quick look at what to expect. So it's widely expected that the FOMC will keep rates unchanged in the corridor of the target range of 4.25% to 4.5%. We have a full preview up on the website for those who want to have a look at and read through that. But I've got an excerpt here from Deutsche Bank's Brett Ryan, who says, we expect the Fed to keep rates steady at the January FOMC meeting and provide limited guidance about future policy decisions. While Chair Powell may not rule out a March cut as he did last January, the broad signals from the meeting should confirm that outcome is not likely. To this end, Powell could emphasize that the underlying strength of the economy and signs of stabilization in the labor market reinforce patience in removing further restrictions. Regarding the meeting statement, we see only a slight change that mainly reflects a mark-to-market adjustment to the labor market language in the opening paragraph. And we'll have a look at some of the nuances there if we get a chance in today's broadcast as well. So with that, as I said, let's bring in Steve. First of all, Steve, welcome to the show. You've not been on it for a while, but it's welcome back, should I say then?
Yeah, thanks, Harry. Good to be here. Well, I'm glad to be back.
Nice one. Thank you very much. And Joseph, welcome again, one of our regular contributors.
Oh, thanks for having me on.
Awesome, brilliant. Right, let's start with you, Steve. Today's FOMC meeting. What are your initial sort of views on it, and how excited should we be about today's meeting?
For me, it's not too exciting, I must say. I mean, I think the fact that, and I know we're going to go on to talk about the price action we're seeing, particularly on the stock market this week due to DeepSeek and the ramifications of that. So I won't go into that too much at the moment. But I think that's sort of normally the beginning of these weeks, as you know, Harry, having been around as long as I have, that we will see like a consolidation mode in most markets going into something like the Fed, particularly when we then stack on the back of it, you've got, the some of the Magnificent Seven stocks coming up, reporting this evening and again tomorrow. So all of that combined, I think, would normally make this quite, yesterday and Monday would have been fairly quiet in the markets, but we obviously seen the flip of that, really, we've seen, huge volatility, some of the biggest moves, the biggest ever down move in market cap terms for any one stock with Nvidia. And so that's sort of taken a bit of the shine off of what, as is already, as Brett Ryan says there, is, fairly a Fed meeting that's not got too many fireworks attached to it, as it were. And I saw a quote from Goodluck saying this is the most nailed on. What did he say? He said it's the most predictable no change in recent years. So no change is completely hammered on. I follow the CME's FedWatch tool. Which is basically just follows like the interest rate curve, really, the Eurodollar curve.
Right.
And what's that showing? That's showing right now at the moment 97.3% chance of unchanged. So that's fairly nailed on. And as he indicates there, I don't think it's really only a slight change expected on the statement. So I think it's all about the press conference and what Powell says and what the questions he gets as well, particularly as there's a new president. There've been obviously words between Powell and Trump previously. He's going to no doubt get questions from the press on that, from the media, and is his position tenable if he doesn't cut rates? As Trump was on at Davos basically saying central banks should be cutting rates. Well, it may turn out that Trump's policies going forward, if they're inflationary and we get a rollover in some data, that the Fed might be being pushed to do, the curve is not telling us that they're going to be hiking rates anytime soon. But, there might be a shift away from, we've only got 2 rate cuts priced in now, probably not March. I mean, again, on the FedWatch tool from the CME saying 68% chance of no cut in March as well. So I think it's going to be really interesting. More the language about the questions that we get being aimed at Powell regarding Trump, the Trump policies. And, he knows what he's doing, so he's going to be very cagey with that. But then equally, the potential policies, we don't even know what those policies are yet. And we've got some hints of them. But, the chances are they could be inflationary. They could lead to slow down the economy. And it could certainly change the tune of the Fed very quickly.
Just to cut in there, that's probably quite convenient for Powell that it's like talking about, when you get these football managers that talk about a situation rather than their team's poor performance. At this stage, he doesn't really want a lot of chatter about the Fed monetary policy. He'd rather probably field questions about Trump at the moment because it's an easier deflection. It's like no comment, this, that, and the other. Whereas, when you're fielding questions, I guess, about monetary policy, you have to walk that fine line. I want to bring in Joe. Joe, what do you think about today's announcement?
Well, it's been a while since I've seen such a consensus on no move. So I don't think anyone's expecting anything with respect to moves or the press conference. I'm not sure on balance if that much has changed within the FOMC, but even though we've had a lot of news since the last meeting. On the hawkish side, we're coming off a firm beige book and a strong employment report. And on the dovish side, we should get a second consecutive soft core PCE print later in the week.
Yeah.
So I think those things more or less cancel out. This is also the first meeting of the year, so we have some new voters. Goolsbee, Collins, Musalem, and Schmid are the new voters, and Barkin, Bostic, Daly, and Hammack are out. So it should be interesting in that we replaced some moderates with members who are more on the extremes. So while Hammack, the dissenter from last meeting, is out, we should get more dissents this year than in a typical year, just because of that distribution. That having been said, no one should be dissenting this meeting because I think it's such a sure thing that the Fed's not doing anything. And then with respect to the press conference, I'm actually going to look for some changes in tone. In particular, I want to know if I'm going to be able to tell from the presser to what extent the Fed may have priced in more of Trump's policies. Right. If you recall from the December meeting, I want to guess that roughly half the members didn't make any assumption about Trump's policies because they said they didn't know what they were. So now that Trump's been president for almost 10 days, we have a better idea of what some of his policies are going to be. And I'm wondering if the tone of the presser is going to reflect the fact that more people have started to price in some of Trump's policies, especially since the tariffs are allegedly going to go into effect sometime this weekend. So that's the first thing I'm going to look for. And then the second thing I'm looking for is Powell's response to Trump demanding lower rates. Because as we saw in the past 5 months, when the Fed lowers rates, when it is slightly inappropriate to do so, the markets are going to punish the curve by driving the longer end yields higher. And so, which in effect will be punishing the economy. So in a way, I don't know that the Fed has that much control over the markets. And so cutting early when the market disagrees will have adverse opposite effects. So I think Besant will know this as a trader, and he will have somewhat informed Trump. But Trump's a showman and a finger pointer, so he's always going to say that rates should be lower for his base. I'm assuming that Powell is just going to be defiant and curt, but to the extent that Powell says something about lowering rates or, what is appropriate Fed action in the current environment, I think that should be, that should be interesting. And then in terms of market pricing, they're currently 48 basis points priced for this year. What's interesting is that almost all of this is priced into this year, and the markets are starting to price in a bit of a hike starting the middle of next year. And so there's always the risk of a crisis ease or the data turning unexpectedly south. But with the tariffs being rolled out in the first half of the year, regulation rollbacks occurring the whole year, and legislation kicking in later this year, it's not clear that some of the eases couldn't get pushed out until next year. So the market reaction to the Fed should be interesting. Someone had pointed out that typically the longer end tends to rally around Fed meetings. I'm not sure that you can go on that necessarily, but we have seen a little bit of a reversal the last couple of weeks.
Yeah, well, go on, carry on.
Oh, yeah. So I think part of it is just that, a popular Trump trade in fixed income land was to be short fixed income. And it's not clear that we haven't been seeing a reversal since the inauguration, just as a sell the news type of event. So I'll be very curious what the longer end of the curve does after the Fed meeting.
Yeah, interesting. Just on, I want to sort of now turn a bit more to the Trump. If you have a look at the chart I have here, how will proposed tariffs impact the US economy? It's a Deutsche Bank table that they brought up, and it's interesting, like 10% universal baseline tariffs, and it has a load of connotations on that, and I'll put this up on our site for people to have a look at afterwards. But it is really interesting to see. There is that fear about the inflation, but there is a payback on the other side as well. So I don't think it's all tipped for an inflationary bias in all aspects of the tariffs and the executive orders that President Trump brings in. So it's going to be interesting on that front. But bringing it back to the markets a little bit now, I want to turn a little bit more, and we can come back to Trump and tariffs and the effects on GDP, because we do have GDP out this week, as well as the PC, as you've mentioned, Joe. But Steve, do you want to quickly just, we wanted to take a look at this DeepSeek and this NVIDIA story and the wider implications of that. So where do you view that? What are you looking at from that perspective?
Yeah, obviously there was the knee-jerk reaction. It did. Obviously the news breaking kind of over the weekend. Market actually didn't open. It did gap lower on the stock indices. So they gapped lower. NVIDIA was down in pre-market significantly. But I think what's interesting is that, intraday we saw a really strong rebound recovery on the major indices, to a lesser extent with Nvidia. Nvidia was obviously the big casualty, but you would argue that that trade is, it's a very, very crowded trade. There were easy stops to be run on the futures because it was on the pre-market on a Monday. So that's going to accelerate everything as we know. And I think the turnaround has been, I was calling for the turnaround. We do a webinar, similar webinar to this every day, a trade day. And, I was calling for the rebound on the Monday. We got a further rebound yesterday on the broader market. And I do think that there is still risk to the upside. ASML, who has certainly damaged as well on Monday, put in some stellar numbers this morning and have rebounded and pretty much got back all of the losses. I think it got back all of the losses and maybe a little bit more since Monday. So ASML is shaping up pretty good. And then we're at a point now where the S&P this morning has already made it back and poked into the gap. They sort of set back a little bit since then, but it went and poked into the gap already. That gap's now 61.11 and a half to 61.22. So that's the kind of line in the sand on the S&P. But the Nasdaq hasn't quite got up to its gap. But that gap's up at 21.771 up to 844. These are both on the futures, by the way. But what it does mean for the S&P future is that that's just below now the peak from last week. And remember, the peak from last week is the all-time high. We're not far back off to the all-time highs on the broader market. So as much as it was worrisome, I think, on a short term, the headline grabbing, X, whatever it was, billions, trillions wiped off the stock market. I don't think, for the economy, it's not super bad. For the tech sector, it's not super bad, and it can be looked at. I mean, I've seen plenty of articles, written that, this is actually positive for Nvidia in the long run because it just brings it more into the mainstream and creates more demand, bigger picture. So for me, it's far from a negative. And I think what's going to be really interesting is the numbers we get tonight from not so much Tesla, but Meta and Microsoft. And then I think we have is it Apple tomorrow as well. So I think, all of that in the next, I know this is a Fed show and we're talking about the Fed, but I mean, a Fed almost playing second fiddle at the moment to the ongoing big tech and AI boom that, has dominated markets for a year plus now.
Well, that's interesting. I mean, there is the plunge protection theory that goes on anytime we see any kind of negativity for the equity markets, that the plunge protection team comes in and just softens any kind of blow. Joe, do you see any? I don't believe this at all, but do you see any circumstance where if this has been a sustained fall, the Fed may have looked at this scenario and just gone, we need to do something about this, or we need to reinforce, I guess, some surety in the markets?
Well, I don't think a couple of point dip in equities is going to affect the Fed whatsoever. In fact, I think if it's not a precipitous decline, I don't know that the Fed wants to do anything because they are trying to, tighten financial conditions. While people in equities may think a 5% dip is a lot, at the end of the day, I don't think the Fed's in play until, we start getting to the 20%, 20% dip area. My general reaction to the whole DeepSeek story is that, I understand the argument that U.S. equities have been powered by AI and the big tech narrative for the better part of 2 years now. And it's unclear to me how much of a correction we can have. I think shorter term, DeepSeek is an open source piece of software, so it's bad for the hardware makers. It's probably about neutral for software makers since they may be a little behind on software, but they will save a lot of money on hardware. And at the end of the day, this is a great development for end users. So I think the recent price action in the equity markets could be considered reasonable. I think the market results could have been different if the software was not open source and the information was not shared. So this is, I think, is going to be a story that's going to take at least a few months to play out. And so it should make for interesting equity trading the rest of the year, because it's not clear how much froth, if any, will be taken out of the market. And to me, the million-dollar question is, does China have a permanent advantage in AI, or was this just a one-time, fluky development that they happened upon? So, because if they do have a permanent advantage, I think the stock markets would take that a lot more negatively than it has so far.
That's a good point. Well, but what I would say on all this is that you've already started to see mumblings about China's hand round the back of this tool, and you can only ask it certain things. There is, it's only got certain again usability, and also the regulatory issues and everything else about that. You can already see people starting to close in. But my feeling on this, and it means nothing, but if you have seen companies spend billions and billions of dollars on capex regarding AI, and you've seen someone come along and do this for a fraction of the price, that money's been sunk. It's sunk. So do they try and how do you get that back? How do you bring that money if it happens to be as good or even nearly as good as the Chat GPTs of this world and so forth, the Bings and the Microsoft product? That's a lot of spend you put in there for essentially to be neck and neck with a relatively small competitor. So I'm still. I think you're right, Joe. I think it scratches his head, but it plays into that. I guess the productivity issues we have, and that's nothing but a plus. If AI comes along and brings about some productivity, all the better. But as we've seen before, as we've feared before, the evolution and what that means for manual jobs, what it means for manufacturing, what it means for low-level service industry, whatever it may be, financial services, we'll have to wait and see. That brings me on to growth and activity really for the US economy. We do have GDP data out tomorrow. I want to touch upon that very quickly. Steve, I know you have to, you'll be shooting off, so we'll come to you first. You got GDP out tomorrow. We're looking at a 2.7% annualized quarter over quarter rise from the estimates. Previous was 3.1%. Personal consumption still holding up well at 3.2%. Deflator, that's looking a little bit on the toppy side at 2.5% for this quarter if expected. That's up from 1.9 if it comes in. That core PC deflator, this is the quarter and not the monthly read. The quarterly read seemed also moving higher for the last quarter of last year. So what are your quick views on tomorrow's growth data out the US?
Yeah, as you know, Harry, this is not my strong suit, macroeconomics. But I think I'll probably leave you. I do have to hop off, so with a couple of things. I think the PCE, the month-to-month numbers we get on Friday probably kind of end up eclipsing these data and this data, and it's it's going to, and I'm sure going to be focused on that going forward as well. But I'll just leave you one tidbit here on another level, which from a technical analysis side is I think the 10-year yield. So on the 10-year yield, and it's not just because we're a round number at 450, but we're hovering just above 4.50. 4.50 to 4.485 is a really kind of critical little area. It ends up creating like it's a head and shoulders top on yield. So, a base for price. So if we get down below like 448.5 on yield, then I think there's a real risk that yields could go significantly low. And I know that's not necessarily what we're looking at here on the GDP, but
no, it is. It all plays into it, though, doesn't it?
So whether that's triggered by the Fed today, or whether that's triggered by the big tech earnings we have this evening, or whether it's triggered by the GDP. But I think that's going to be, I'll probably leave you with that. That's going to be a critical, and then that will play into where equities can go after that as well. If we do see a significant move lower in the long end yields, as Joe was talking about earlier on.
Yeah, because they're scared of the rapid moves in those yields. Steve, thank you very much for your input, and we'll get you on again in the near future as well. But I know you got a hop, so thank you very much.
Thank you. Thanks. Bye.
Cheers. Joe, just on the data, well, we can talk about the yield effect and everything, and how rapidly that moves and the effect on equities in a little bit before we close out. But do you have any views on the GDP data tomorrow, or is it really for you as a trader, as someone who looks at these markets, just too backward looking and it's not really as relevant now?
Yeah, I agree with Steve. My focus is more on the PCE data on Friday. The only comment I have on GDP is that the markets have been underestimating GDP for most of the past year, and the Atlanta Fed has an estimate of 3.2. I'm not sure if they have updated it for the inventory data that just came out a little while ago. So, because you would have expected more inventory accumulation ahead of Trump tariffs, so that may have been what's been boosting inventories most of last year. So I think the two things somewhat cancel out that, there probably was some inventory accumulation, but I'm not sure what this inventory data was that came out earlier today. But just kind of moving along to core PCE, because the GDP is very backward looking and I try to be more forward looking, is that the markets are expecting around a 0.17 month on month on core. And so that would make it the second low core PCE print in a row. And in that way, I think the markets have taken some of the hike probabilities out of the curve, because for the Fed to overcome these two low core PCE prints in a row, I think they probably need about 4 high PCE prints in a row for them to get off of these 2 low prints in a row. And also, core PCE year over year has been at 2.8%, assuming that's what it comes in later this week, which means that there will have been no progress on that statistic for the last 7 months. And so, in a way, I think that's why the market thinks the Fed's not going to do anything in the near term, because we've effectively taken the hikes out of the curve, which may have partially been responsible for a little bit of this rally. And, we're sort of taking some of the near-term eases off the table as well. So it looks like, it's the Fed's probably going to be inactive for a few meetings.
Well, it's interesting. Nick Timiraeus there of the Wall Street Journal, who people do look at and listen to, as having the ear of the Fed. With the December CPI, PPI, and import prices in hand, forecasters who do the math expect core PCE prices to have risen 0.18. This annualizes to 2.2% in his opinion. This would hold the 12-month rate at 2.8 and lower the 6 and 3-month annualized rates at 2.3. So similar to what you're saying in terms of where we're currently at. And so just to round off before we finish for today then, PCE trading today and looking at today, tomorrow, and then on Friday, if we don't get anything of any kind of substance from Powell, we should see a fairly reactionary action after the event, and then move swiftly on to the PCE. Is that or GDP tomorrow, and then the PCE? You're not looking for any kind of long-term reverberations unless he materially changes his comments at the press conference.
So usually I'll look ahead a few data prints. So I'm focused mainly on the FOMC today, and then the next big thing up is this core PCE. But it's somewhat predictable. So the next really big thing on the calendar is going to be how the Trump tariffs are implemented this weekend, and then the payrolls on Friday, the Friday after this Friday. Because this is actually, the payrolls this Friday is actually a really big one in that we should get changes to the birth death model. So, and we should get some revisions. And so, a lot of the Dubs have been saying that the establishment survey has been high all year. And one of the causes could have been the birth death model. So I think there could be some market positioning going into that. I would think the Bulls would probably be a little bit more in charge than the Bears. But again, it really depends on what Powell has to say today.
Fair enough. On that note, I think we'll leave it. Joe, thank you very much. That's Joseph Choi from The Curve Advisor. And earlier you listened to Steve Miley there of Trade Day. Again, thank you, Joe and Steve, for your input today. Just to recap, then we're looking at FOMC tonight to leave rates on hold at 4.25% to 4.5% target range. And it's really more likely going to be more about the statement and any tweaks we see from that and the press conference from Fed's Powell. Just to give you a note from a JP Morgan piece here to finish off on, because they speak. This is from Mike Ferroli of JP Morgan. He says, we expect another relatively insignificant edit to the statement. For example, the last statement discussed the state of labour market since earlier in the year, wording which no longer makes sense. We expect the updated assessment of current conditions to reference solid activity growth, an unemployment rate that is low, and inflation that has made progress but is still somewhat elevated. We expect no mention of trade or other policy issues looming on the horizon. And then says, regards to the Powell's post-meeting press conference, has often stolen the show on FOMC Day in recent years. For this week, though, however, we expect he will adopt a more of a duck and cover approach. In particular, we anticipate he will indicate each committee participant is using their own conditioning assumptions on what trade policies are ultimately adopted, and that the only thing decided at the meeting was the monetary policy statement agreed to on Wednesday. So on that note, thank you very much for listening, guys. Liveswalk.com, if you want to trial of the service and understand what we do. The Curve Advisor, please go and have a look at the blog. Is it on Substack, Joe?
Yes. And thanks for having me on. And I wanted to wish all of your Asian listeners a happy Lunar New Year. So it's not a big holiday here, but most of the Asia region celebrates this as a major holiday. So I just wanted to wish everyone a happy New Year.
Year of the Snake, isn't it?
Yes.
Awesome. Thank you. That's a good note to finish on. Thank you. Thanks for tuning into the Live Sport podcast. Your edge in the market starts here. Subscribe now.